Welcome to our lecture series on financial management. Today we will talk about one of the most important financial statements, namely cash flow statement. Let's begin. The cash flow statement, also known as the statement of cash flows, is one of the three primary financial statements, alongside the balance sheet and income statement. It provides detailed information about how cash and cash equivalents move in and out of a business during a given period. The purpose of this statement is to show how a company generates cash from its core operations, how it invests cash in long-term assets, and how it raises and repays financing. It helps managers, investors, and creditors evaluate the firm's ability to generate cash, pay obligations, and fund growth. The cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Operating activities show cash inflows and outflows related to core business operations, such as generating and selling goods or services. Typical cash inflows include receipts from customers and interest and dividends received. Typical cash outflows involve payments to suppliers and employees and interest and taxes paid. For ABC Coffee Co., collecting $150,000 from customers and paying $100,000 for supplies and wages results in a net operating cash flow of $50,000. Operating cash flow can be presented using two methods: the direct method, which lists all major cash receipts and payments directly, and the indirect method, which adjusts net income for non-cash items and changes in working capital. For example, starting with a net income of $80,000, adding depreciation of $10,000, subtracting an increase in accounts receivable of $5,000, and adding an increase in accounts payable of $3,000 yields a net cash from operating activities of $88,000. Investing activities reflect cash used in or generated from acquiring and disposing of long-term assets, such as property, plant, and equipment. Inflows include the sale of property, plant, and equipment, or investments. Outflows include the purchase of fixed assets and investment securities. ABC Coffee Co. Buying new espresso machines for $30,000 and selling old equipment for $5,000 results in a net cash flow from investing of negative $25,000. Financing activities show how the company raises and repays capital, including debt and equity. Cash inflows come from issuing shares or bonds and borrowing from banks or investors. Cash outflows include repayment of loans, payment of dividends, and repurchase of shares. ABC Coffee Company issues $20,000 in new equity, repays $10,000 of bank loans, and pays $5,000 in dividends, resulting in a net cash flow from financing of positive $5,000. Let's look at a complete example for ABC Coffee Co.'s cash flow statement for 2024. With net cash from operating activities at $88,000, net cash from investing activities at negative $25,000, and net cash from financing activities at $5,000. This leads to a net increase in cash of $68,000 for the year, showing the company generated more cash. The cash flow statement is crucial for evaluating a company's liquidity and solvency. It reveals a firm's capacity to pay dividends and debt, and helps detect discrepancies between reported profits and actual cash generation. For instance, a company might report high net income due to accrual accounting, but show negative operating cash flows, indicating cash strain. Key ratios like free cash flow, calculated as operating cash flow minus capital expenditures, provide deeper insights. For ABC Coffee Co., with an operating cash flow of $88,000 and capital expenditures of $30,000, the free cash flow is $58,000. The cash conversion ratio, which is operating cash flow divided by net income, helps assess earnings quality. For ABC Coffee Co., with an operating cash flow of $88,000 and net income of $80,000, the cash conversion ratio is 1.10. However, the cash flow statement has limitations. It excludes non-cash transactions like depreciation and stock-based compensation. Short-term cash fluctuations may also obscure long-term trends, and interpretation requires context from other financial statements. In summary, the cash flow statement is essential for understanding a company's liquidity, solvency, and financial flexibility. While the income statement measures profitability and the balance sheet reports financial position, the cash flow statement connects them by revealing how cash truly moves through the business. It helps managers ensure operational sustainability and investors evaluate long-term value creation, providing a comprehensive view beyond just profits. Thank you for watching our lecture on financial management focusing on the cash flow statement. See you at the next lecture.